Welcome back to the channel, everyone. Manny B Investing in BI, and we've got a Paribus blog posting. How loans work. How appropriate. Since Paribus is a borrowing and lending platform, specializes in standard digital assets such as wrapped Bitcoin, Ethereum, things like that, and also synthetics. So let's take a look at how loans work so you can understand how these new DeFi protocols actually work and the benefit of them. So a surprising number of people worldwide have little understanding of how the modern monetary system works. Ain't that the truth? I struggle with understanding it as a younger person. My family today struggles with understanding it. So we're constantly having conversations about this stuff. And I still feel like they don't really understand it. So hopefully this will clear some things up and I can show them this video. This lack of financial literacy can have significant impacts on individuals and their ability to become more productive members of society, because that's everybody's goal. For instance, many people think that debt is bad without understanding that it's an essential ingredient for growth. All the world's major economies operate on debt-based models, which is paramount to ensure continued growth and expansion. Without the ability to create debt, growth is dictated by the current level of productivity. If a business produces a surplus of $2,000 a month, it can only reinvest this amount to expand each month. With debt, however, this surplus can be leveraged to create a lump sum in the form of a business loan to rapidly expand and create exponential growth. Fractional reserve systems, man. Debt only becomes a problem when it exceeds productivity or growth. In such situations, the burden of the debt weighs heavily on a business and it becomes counterproductive. This can lead to job cuts, sell-offs, and contraction instead of expansion. See Google, Meta, and I think Disney's laying a bunch of people off. I think they're about to drop about 7,000 people. They're not making the right decisions. Just as growth within the physical world is dependent on leveraging debt, the same principle is applied to the digital world. By using debt sensibly, people are able to grow their portfolios more rapidly and move towards securing their financial freedom. A key differentiator between the loan structures of the physical and digital worlds, however, is that digital loans are more focused on equitable transactions. DeFi loans, for instance, are based on the principles of benefiting both the lender and the borrower, with the protocol taking a small percentage of the fees. Physical loans, on the other hand, are based on benefiting one side of the transaction, usually the bank. How sad. We can witness this happening at the moment every time central banks adjust their base rate. Those with loans will see their interest rate increase by the same rate immediately. Savers, however, only receive a fraction of the increase in yield, and this is often delayed by a few weeks or months. So whenever you get that change sprinkled into your savings account, that's why. Rather than adjusting interest rates on the dictates of central banks, DeFi loans are based on the available liquidity and level of demand. Rates are dynamically set and changed instantaneously. When demand is high for a loan and liquidity is low, this incentivizes people to lend their crypto in return for an increased yield. So, for example, Paribus. You can take a look at Paribus when it's on mainnet, and there will be a way to calculate when it is good to provide your assets as collateral and receive rewards in exchange for that versus when it's not. And that'll be really clear on your dashboard. When you look at that, you'll see the rates that you would get for staking your collateral and the rates you would get for borrowing that same collateral. So this is going to be really cool. Can't wait for mainnet to launch. I'm sure you guys can't either. If you can't wait and you've been waiting for forever with me, put the money sign PBX in the comment section. Furthermore, DeFi loans are based solely on collateral and don't involve any credit or identity checks. This makes them accessible to people all over the world, irrespective of whether they are banked or unbanked. So a farmer in Africa, or, a person in America that might live in a place and have made, poor decisions, maybe their own bad decisions, or they were put in a bad position and the banks don't trust them anymore because they might have a low credit score. With these systems, all of that stuff is ignored and it only comes down to the assets that a person has and nothing else. No more discrimination. While this approach may have some minor potential downsides, the upsides greatly outweighs them. It enables many people to avoid predatory lenders and begin to build a better financial future for themselves and their families. Crypto loans typically have a loan-to-value rate of around 70%. That means you need to deposit $1,000 of crypto to borrow $700. Although it may seem strange when viewed in those terms, over-collateralization is the same when you apply for a home loan. Banks may offer a higher loan-to-value rate of 85%. However, they own the property until the loan is paid in full. If their margin slips or the borrower fails to make repayments, they foreclose on the loan and sell the property in the same way crypto loans liquidate. The benefit of crypto loans for the investor in the space is they can quickly and easily unlock some of the liquidity of their tokens without having to sell them. In market conditions such as the present ones, it means people can grow their portfolios while prices are still low. As the cycle moves into its next growth phase, they can settle their loans with some of the profits from their new tokens, so essentially longing the market. Additionally, in many parts of the world, selling tokens is considered a taxable event. Meanwhile, that you may have to pay a tax on the proceeds of your trade, loans, however, are not considered taxable events because you haven't disposed of any of your tokens. This enables investors to concentrate on maximizing the growth potential of their portfolios and time their taxable events more effectively. As the space grows and the people become more financially literate, they will also become more nuanced in their approach to investing. As such, the ability to borrow and lend crypto will be an essential part of growing both the ecosystem and the portfolios of investors. From this perspective, DeFi is critical to the digital economy as banks are to the physical economy. So it might seem silly, it even seemed really silly to me, but as we go and as we do these things and as we experiment with these protocols, especially like Paribus's testnet, you really start to understand like where you can make money and what problems it solves. Someone that doesn't want to create a taxable event for themselves, but wants to take advantage of the market's current state with all the prices being low compared to a couple of years ago or even last year. So instead of doing a taxable event, especially if you live in a place where they're really hounding you and really on your moves with crypto, you can stake your stuff and borrow against it and purchase more and stack and increase the ratio of your loan and make it really healthy and ride into the market. And if you bet correctly, you can repay and you're all good. So this is the article. I think it's a good one. Helps explain some things. Hopefully it helped you. And if you still aren't sure, just drop a comment. We can talk about it. We can answer some questions. But in the meantime, go ahead and hit that like, hit the share, subscribe, and I'll see you guys on the next one. Peace.